Hi there, eToro. It is Wes, and it's Monday. That means it's time to see what happened in the markets last week. Let's take a look. Starting off with the stats, like we usually do, the 12-month return for my portfolio is roughly 44.7%, and the S&P 500, we've got a bit of the pre-market price in here, but it's roughly 4%, 3% behind that. If we take a look at the FinViz heat map of the S&P 500 for last week, you can see that there are a lot of gainers. You can see that there's definitely some patterns in here. So semiconductors had a fantastic week. This is the 1 week, not the 1 day view, by the way. We can see that restaurants, lots of retail and travel companies had a pretty fantastic week. We can also see that some of the areas that are usually flights to safety saw a bit of selling. So we can tell that money has started to run towards the slightly more riskier or perceived to be riskier areas of the market. In terms of the performance from last week, difficult to ascertain a pattern really, because there were lots of earnings coming out, and earnings definitely affect stock prices. There were some winners and some losers. So in terms of sector or geographical patterns, there weren't really that many. UK stocks didn't do very well at the beginning of last week, but they tended to have picked up towards the end of the week. In terms of the losers, I wasn't holding Zillow last week when they dropped. There were several sessions where they dropped massively because they're closing a part of their business. And I picked up a small position there because I think the selling is overdone. Activision dropped because their forecast is a bit weaker than had been anticipated, but also two major titles, Diablo 4 and Overwatch 2, have been pushed out to a timeline unknown. So we don't know when those games are going to drop. But then the other stocks that are the biggest losers, there's no real discernible pattern, like I just said, similarly for the winners. In terms of the UK, so last week was an interesting week. PMIs have come in pretty strong. I think the pattern across the board geographically is that the world has been worried that growth is slowing and maybe reversing, because there were 1 or 2 months where the macro numbers were showing weakness, but it seems that we are seeing a bit of strength again. And so there will be volatility across these numbers as the world reopens because of all the reasons that we know about already. So PMI is really good. The big surprise last week was that the Bank of England kept the interest rate at this very, very, very low 0.1%. Now, it wasn't a certainty. There were analysts saying that maybe they will keep it lower, but I think that probably people were banking on this going up. And the fact that it didn't go up, I think, helped UK stocks through last week. UK stocks have already been pricing in a pretty aggressive timeline for rate increases. So the market was wrong, and so we've seen a bounce in UK stocks. We're also in the midst of COP26. So this is the conference. There are many heads of states, senior politicians, ex-presidents, movie stars that are weighing in on COP26. This is the climate change event that started on Sunday and has begun on, and will be going on through next week. So the first week was lots of talking heads doing what they do best. Several countries making various commitments. There are some companies that are not making commitments. So China hasn't shown up, and because they are a large contributor to pollution in the world, this will slow some of the initiatives that are kicking off at this event. Now through this week, we're hopefully going to see something a bit more concrete. We've also seen a number of protesters and the media weighing in that, you know, people flying in on private jets and the food that they're eating has a very large carbon footprint. I don't think that that's particularly helpful. I mean, sure, maybe it needs to be highlighted, but making that the focus of this event is a huge mistake, in my opinion. We all need to work together here. Instead of poo-pooing one another. So let's see what comes out of this week. What is quite interesting is this report by the United Nations, and so they're synthesized data from the NDCs, so the nationally determined contributions to pollution, and they are saying that we are going to miss our target, and by 2030 the amount of emissions will have increased pretty significantly over 2010 levels. So I think it's good, it's positive that so many leaders are willing to come together to talk about this and hopefully take action. Hopefully we will see a lot more concrete commitments through the second week, the week that we're in right now. Otherwise, in terms of UK stocks, a few of them are just carrying on. Probably the one that I'm most interested in at the moment is Rolls-Royce. So they just sold their nuclear controls arm in order to raise some funds. But also, it seems as though we are going to hear, and I had highlighted this, I'll read it quickly. There were also reports on Monday that Rolls-Royce could make the announcement as soon as Tuesday on its small-scale nuclear plans. So Rolls-Royce is part of a consortium of companies that are designing and looking for investment to build small modular reactors, a new generation of nuclear reactors. They need money, and the government is saying that they would provide some funding if it could be matched by outside sources, and Rolls-Royce is looking to raise some money too. So this is very, very cool if it could get off the ground. I'll try to zoom in for those of you that watch videos from mobile, but effectively, each of these reactors will cost around £2 billion each, which compares to the 20 billion cost of reactors at Hinkley Point. So these are the old school, full-scale nuclear reactors. I encourage you to look on Wikipedia, read up a little bit about these modular reactors. So there are several challenges in nuclear. One is that building a reactor usually takes so long that by the time you're finished building it, there's brand new technology out there. Obviously, for the past 20 or 30 years, sentiment around nuclear has been very negative, and I think the world is starting to change its mind. There's a lot of information being circulated that shows that they're nowhere near as dangerous as the common perception seems to be. They need a significant amount of investment just to get off the ground initially, and the reputation for execution of nuclear projects isn't fantastic, so they can take decades to get up and running. So there are a lot of risks, and because they are potentially dangerous, there's a lot of oversight required in order to license these plants. So many challenges, but it seems as though the governments of the world are finally coming together. Companies in the world are coming together to swarm around these problems and solve them in the proper way with the right kind of support, political, financial, etc. Moving on to the US. So there was some interesting data out of the US. Again, PMI is better than expected. We saw some unemployment or employment data out of the US, and it seems pretty good so far. One of the most important things I wanted to talk about with regards to the US market is the broadening rally. So you might see some people on Twitter or inside of eToro talking about the breadth of the rally, and I just wanted to explain that very quickly. So in the S&P 500, the top 10 companies, the 10 largest companies, make up 28.5% of the index. In the Nasdaq, we see a similar story. There are a very small number of companies that make up a very large part of the index. So if these collective companies, and the names will be recognizable largely, so if they were to move collectively on an aggregate 10%, that would mean that the index, if nothing else in the index moved, would increase by 2.85%. They have a lot of power in the index, a lot of power to move the overall index. And to some degree, that is what has been happening through the year. So the Nasdaq and the S&P 500 have been powering ahead, whereas a lot of investors have been holding many stocks that are smaller than these businesses that we see on screen, the mega caps. Yet somehow they're losing to the market. The market keeps on going up. When I say the market, I mean the big indexes. They're going up, but a whole bunch of other stocks have been left behind. And if you look at the numbers, actually, over the past few months, there has been a correction beneath the surface of these indexes. And that is because the rally has been very narrow. So very few companies that have the power to move the indexes have been rallying as investors have rushed to safety, because the big caps, they offer growth, but also they're safe, they're not going to die out. And that means that a whole bunch of other companies have been left in the dust, some of them very good companies. That's not the interesting part. The interesting part is that the Russell 2000, which is usually seen as a benchmark for smaller companies within the US, so you can read about it a little bit here. So it's a market index comprised of 2,000 small cap companies. It's been trading in a very consistent range since February earlier this year. And what we have seen very recently is a breakout to the upside. So finally, the bull market is spreading out. There's a bit more breadth. And this has been going on since the beginning of the bottom of March 2020. We saw tech companies rallying, very, very narrow rally. And that kind of thing gets scary because that's how you develop bubbles. And then in early 2021 of this year, that broadened out a little bit to encompass more value stocks, as well as a few other large corporations here and there. But largely, the rally has been in the larger cap companies. Now, finally, this is broadening out even more to the smaller cap companies. This overall signals that we are good to go in terms of a healthy market. I know that there's been quite a run up in the major US indices for a while. And like always, there are always people that are crying that there's going to be a major correction. But this actually shows us that the bull market has become a bit more sustainable in broadening out. Last week was a major week for earnings. So I've got last week up here, and we saw mostly good earnings out of companies, I would say. And there were a few misses, notable misses. I've already mentioned Activision being slightly weak and I think oversold on that news. We also saw some interesting information out of other companies. Zillow, for example, is undergoing a major business change. Square had a soft patch in terms of its Cash App for the first time in ages. We saw a lot of companies with supply chains, long, complicated supply chains, having weaker quarters and issuing sometimes weaker guidance. So First Solar being one of them. Solar overall sold off a little bit last week, and that's why I had really cut back my solar position going into earnings. But then we also saw some incredible surprises. So Mercado Libre, fantastic beat on earnings, 50% higher than analysts expected. And Mercado Libre, if you follow my videos, you'll know that it's a company that I love. It's a very, very strong business. Their last earnings report, they beat on earnings analyst expectations by over 1,000% or somewhere around 1,000%. So the stock price dripping down over the past few months has been a good opportunity to load up on more stocks. GoPro is another company that has been hated by a large number of investors, and I have no idea why, because they have been showing that they know what they're doing and they're executing very, very well. And we saw a bit more evidence of that in their earnings report. So I think the stock price for GoPro has been dripping down for, I think, 4 months or 5 months. And now I think that there's been a bit of an enthusiastic injection into the stock. And I think that we might see all of that reverse over the coming months. Over the weekend, we saw the much lauded infrastructure bill making progress, the $1 trillion bill. I think this is fantastic, but I do wonder how much this has already been priced into the market. I'll be watching certain bellwethers of infrastructure through the session today, so Caterpillar being one of the most obvious, to see if there is any rise based on this. But as I said, I think that the market was expecting this to pass eventually. Okie dokie, on to China. So the market has been very concerned about slowing growth in China. China's economy reopened ahead of most of the rest of the world, and some of the macro numbers have been pointing to a slowdown. Whenever there's a slowdown, the market tends to overthink it and usually starts thinking, uh-oh, things are going to start going in the other direction now. However, we found out recently that Chinese export numbers are still doing very, very well. So you can see through the past few years that exports, which are a large, large part of China's economy, have been doing fantastically. That doesn't mean that there is nothing to be worried about in, I would say, the short to medium term with China. For example, they still have the challenges around energy to run their country that they had earlier, although that seems to be abating somewhat. They are importing huge amounts of coal from around the world. And for some reason, they are super committed to their COVID zero policy, which most countries that had this policy initially have abandoned. So that means that they are trying to crush infections entirely within their borders. as opposed to what most countries are doing now, which is aiming for very high vaccination rates and then letting coronavirus run through the population. The reason that this is a challenge is, what effect does it have on the overall immunity of the population? So is it good for the people? I'm not sure. And as long as this continues, it's majorly disruptive to the running of the country within its borders, but also in terms of creating things for the rest of the world. What is quite interesting, and I don't have the article up now, is that shipping costs seem to have topped out and might be dropping now. I had a feeling that we would be in peak supply chain crunch around Q3, Q4 this year, and I'm starting to see data that implies that that might be the case. The market is forward looking. And so if it looks like we are reaching peak supply chain issues now, then the market is likely to start getting optimistic about how things are going to be through 2022, which means that we could see the rally compounded even further. Okay, and what about the rest of the world? So some things that I'm watching, the world is a big place, so I can't watch everything. There is a leadership battle going on at VW. So I haven't checked for updates this morning, but the leader of VW, who I think has been great for the company, who's been trying to push the EV agenda for the business, is also a huge fan of Elon Musk and Tesla. He's even invited Elon Musk into his company to talk to the leaders within his business. He thinks that VW can be a far more lean operation and they can improve efficiency massively. But part of that would mean laying off huge numbers of employees. Big companies on the journey to becoming big, they usually acquire a lot more people and they become a lot more bureaucratic and they grow fat over time. So effectively what he is trying to do is reverse that and trim the company down. But the unions within Germany don't like that, and they're beginning to challenge him and throw mud effectively. The unions have a lot of power in Germany, so it could be that we're looking at a new leader for VW in the next few months. Gold also had a bit of a run last week. So just looking at the performance of the commodities that I'm tracking. So you can see that gold is up on the month actually, after being very, very stuck at a low price level. Gold has been behaving very strangely, and so I am wondering if gold has been ticking up because tapering has been announced and many governments around the world have said that they're going to start raising their domestic interest rates. So the real rate will effectively rise, and this usually is good for gold. We also quite often see gold rally late in Q4, and I know we're not late in Q4, but gold does tend to rally late in Q4 and early in Q1. I was also going to talk about solar stocks, but I've kind of mentioned that already. We can see that TAN, the solar ETF, has given back some of the returns from a month ago, but not that much. I still think that we are in the midst of a secular change that will see many solar companies growing much, much larger than they are today. Things like the infrastructure bill in the US are just the beginning. We're going to see that kind of pattern, I think, rolling out across the world. In order for the world to reduce its reliance on fossil fuels, solar, wind, and other companies are going to have to grow their market share. Okay, what about the week that we're in? So earnings are still going to be a major focus for the market. I think that a lot of the big names have reported and earnings will start to slow down now, but as you can see here, there are still some pretty big companies that will be reporting. Alibaba won't be reporting tonight. I think it is reporting on November 18th. And that is one that I am particularly interested in. I think I'm not the only one. We do have Singles Day this week. So this is one of the larger shopping events through China, and it should give a boost to revenue and earnings for Alibaba. Some of the names that I will be watching through this week very closely are Disney, Arrow, and Nvidia, which I don't see their logo here, but they're a company that I have held for a long time. A small company that's growing revenue massively, but has yet to become profitable. One of the more moonshot type companies in the portfolio. We've also got the usual set of economic data coming out of the various major economies, but the ones that will be most important to the market will be the inflation data out of the US on Wednesday and the GDP numbers out of the UK on Thursday. All right, that's it for this week. I will speak to you next Monday. Have a great day. Goodbye.